Hi, this is Hetal Gandhi from Crystal Research. I am happy to join the Mint Conversations. Today we will be speaking on India Inc.'s revenue and profit growth expected for the second quarter of 2020. Let's look at the analysis which is being done by Crystal Research. We expect that revenues for India Inc. would drop to a 14-quarter low with a decline of around 3%. This is for the first time in 14 quarters that we are seeing such a sharp drop in revenues. This drop in revenues is mainly on account of slowdown in the consumption sectors. If we look at the overall analysis done, our analysis covers around 430 companies which are spread across 19 sectors. The consumption sectors account for a larger pie of the total 430 companies which are being evaluated. Within the consumption space, automobiles industry is seeing a sharp drop in revenues. Listed automobile players are expected to see almost a 24 to 25% drop in revenues. This is in line with the sharp drop in volumes which we experienced in the second quarter. We also believe that auto component players would see a drop of around 14 to 15% in revenues in line with production cuts announced by automobile players. The worst is not over as FMCG players are also seeing moderation in growth rates. We are expecting that FMCG companies would see a revenue growth rate of around 5 to 6% in the second quarter as compared to an average of 10 to 11% over the last 5 quarters. We therefore believe that the slowing consumption growth rate is the key reason why India Inc. is expected to see a decline in revenues. If we shift our focus to construction-linked sectors, the picture is not different. Steel companies, for example, are expected to see almost a 15% drop in revenues in Q2. This is in line with steel flat prices falling by around 14% and demand remaining muted. If we also look at cement players, which is another construction-linked commodity, we see that revenue growth rate is moderating to around 5 to 6%. Whatever increase in revenues, a larger proportion is getting contributed by increase in realizations. Realization increase is almost 4 to 5% and volumes are either moderated or muted or they have dropped across regions. We therefore believe cement companies also will continue to see lower growth rate. Now let's look at certain capital intensive sectors. Petrochemicals, for example, is expected to see a 24 to 25% drop in revenues. Power sector is also seeing a moderated growth rate at around 3 to 4%. This is lower than the past 4 to 5 quarter growth rates seen by this sector. The reason why power companies are seeing lower growth rate is a fall in demand and at the same time PLFs across thermal power plants dropping to around 55 to 56% as compared to 59% in the previous quarter. We therefore believe that most of the sectors of India Inc. are seeing slower growth rate in the economy. There are a few exceptions. Airline services and telecom is expected to see a much better growth rate as compared to the past few years. Consolidation in both the sectors has helped to revive pricing power. We believe telecom players are expected to see a double-digit growth rate in revenues in line with stabilization of pricing in the data segment. We also believe that airline companies would see almost a 40 to 45% growth rate in the listed space. This is mainly because most of the low-cost carriers have added capacities over the last 2 quarters after the grounding of Jet Airways. We also believe that pricing power has returned for the first time after many years to the airline space. Average airfares are expected to go up by around 5 to 7% for the quarter and for full year as well. After looking at revenue growth rate, let's now turn our heads to the EBITDA growth. EBITDA growth rate also is moderating significantly in Q2. In the first quarter of the year, we saw EBITDA profits for the same 430 companies grow at around 7%. This growth rate is now coming down to 0 to 1% for Q2. Basically, fixed cost increasing is offsetting the impact of lower commodity prices. Most commodities, as I mentioned earlier, have seen a drop in prices. Whether one talks about steel or naphtha or coal, iron ore or even crude oil, there is a sharp drop in most commodities. However, higher fixed cost is offsetting the impact of these lower commodity prices. If one looks at segments like automobiles, you will see almost a 200 to 250 basis points of EBITDA margins being shaved off. In fact, if one removes sectors like telecom and airlines, very few of the many sectors who is seeing an improvement in margins, you can see that the overall EBITDA growth is actually expected to see a shave off of around 5 to 6%, similar to what is happening to the revenue growth rates. We therefore believe that 10 out of the 19 sectors that we have evaluated is seeing a drop in EBITDA profits. The situation is therefore pretty grim for the second quarter of 2020.